Hey traders, Jason here from Leavitt Brothers. Happy Thursday. Let's do an update of the state of the market. The index has cycled down to the bottom of the ranges, but market breadth held up. So I told subscribers at Leavitt Brothers to treat the weakness like a dip within an uptrend, not the beginning of a downtrend. Now the indexes have cycled back up. The S&P kind of close to its high, Russell back in the middle of its range. So let's check out the internals and see where we stand. All right, so here is the S&P 500 up top, AD line down below, 10-day AD line in the middle. So what I see here with the AD line, we got a higher highs, higher lows, and a definite uptrend above a trend line and above the 50-day moving average. I see no warnings here. This is probably my number one indicator as far as the overall market, and I see only good things here. Okay, if you compare it to say last September, where we had market had higher highs and this indicator dropped, okay, obviously there's a big difference between back then and right now. Okay, little dips will happen, that's fine, but for now, with the trend, higher highs, higher lows in place, we have to respect the market's uptrend and the beneath the surface upside bias. All right, now looking in the middle pane with the 10-day. What I see here, and you guys know the routine here, when the market is healthy and doing well, it oscillates up and down within a range, mostly above zero, but it does dip below. So what I see here is the same exact thing has happened going back many months. Okay, so what we have here is we had a dip and a drop here, and then some consolidation beneath zero. We had a dip, indicator went below zero, consolidated. We have a dip, indicator went below zero and consolidate. I consider these just to be normal dips within an uptrend. Okay, now when you get a bigger dip as we got down here, then that hints at something worse. Okay, but for now, this is indicative of an uptrending market, a healthy market, which is just pulling back, occasionally pulling back within its uptrend. Okay, if this would have broken down and gone like this, different story, but it went down, consolidated for a little bit, and now it moved back up. So bulls are back in control. This could last for many more months, who knows, but for now, bulls are in control, biases to the upside. Here are the 80 lines, advanced decline lines based on market cap, large cap, mid cap, small cap. Okay, what I see here is just all supportive of the uptrend. We have higher highs, higher lows, uptrend, 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 all three market caps, uptrend. Okay, so if this would have, instead of going like this, if this would have fallen off like this, then we would have gotten a little bit of a warning. Okay, but it didn't happen. All three cases, no matter how big, small companies are, advanced decline lines are trending up. So this supports the upside. Okay, here we got SP 500. We got new highs in the middle, new lows down below. When the market is healthy, you get oscillating new highs in a range. Okay, as we've gotten most of the last year. Okay, and and when we got like low prints, that's when the market ran into trouble. Okay, so as of right now, with the market, we got a little dip here during this pullback, and we got a little dip here during this pullback, but in both cases they quickly recovered. So as long as the new highs just oscillate up and down in this range, then I'm gonna stick to my guns and just say the market's doing well. It could trade flat for longer, but for now it's doing well, and I don't expect it to break down. This means that I will treat dips as dips within uptrends as opposed to the beginning of something worse. Now, if something changes, I'll note that. I'll send out another video, but for now, I see this indicator being in good shape. Okay, taking the highs and the lows, putting them, throwing them into more calculations to see how they operate. Here's the high-low, highs minus lows, and then the cumulative highs minus lows. So I just want to point out a few things here. So we have a dip here, and the high-low differential just dropped below zero and then recovered. Dip here, drop below zero to a shallow level and recovered. Dip here, drop below zero to a shallow level and then recover. Okay, this is indicative of a dip within an uptrend. You can go back and look at like this dip. You have minor moves below zero. This move actually caused a much bigger dip. Okay, so there's a definite difference between a dip within an uptrend and the beginning of a downtrend. Okay, so as of now, as long as the high-low dips below zero, doesn't penetrate too far, and then recovers, I'm going to treat it like a dip within an uptrend. So far, that's what we're getting. Down below, you have the cumulative line. This dip over here caused it to cross the 50, and obviously it trended down. Okay, so there's obviously a big difference here. The market fell here, and look at the cumulative line, just went all the way down here. The market fell like almost just as hard here and here and here. Oh, this one's not as long, but it fell just as intensely. And what did you get? You got a little minor dip here, little minor dip here, little, I mean, barely doesn't even show up there. Okay, so it's pretty obvious difference between a dip within an uptrend versus the beginning of a downtrend. So right now I'm treating pullbacks like they're dips within an uptrend, and I expect the market to eventually break out to the upside. Okay, here's the Nasdaq with the Nasdaq cumulative 80 line and the 10-day line. A couple things I want to point out. Okay, similar to the 80 line with similar to the 80 line with the NYSE. This is the 80 volume line. So you get a dip here, so you get a move down and then consolidate below zero, move down, consolidate below zero, move down. This one fell a little bit further, but it recovered. So same thing. Compare that to here, where you got a much deeper move down. Okay, so there's definitely a difference between the two. As far as the cumulative line, we have, higher highs, higher lows. This is a little bit flatter. Not overly concerned, but you can see like the difference here. Now another thing I want to point out is what happens at tops. Let me get rid of those lines so they don't clutter it up. You can see here this is close to a higher high, not pretty close, and this is a very obvious divergence where it goes down to zero. Okay, that's higher high. That's an obvious divergence where it goes down to zero. Higher high, obvious divergence where it goes down to zero. Now there's other divergences like over here, but this one doesn't go down to zero, so I don't think it's worth as much. But when you get a divergence and the second hump is down near zero and then it falls below, that's a little bit of it signals a little bit of a trouble. Obviously we're not there yet. Okay, we only have like one hump. We don't even have a hump here. We're just like, we're cycling up and we're like restarting the clock at zero. So who knows? Maybe this thing goes up and comes back and then goes up again. And, maybe while it goes up again, it kind of does like that and it gives us a warning. But for now, I don't see a warning. To me, the trend is either up or flat and dips are buyable. Okay, here's the S&P 500 up top. Down below is the percentage of stocks trading above their 50-day moving average. Let me draw a line at the 50% line. Okay, so market trends up, you get these lots of, whoops, I don't want that. When the market trends up, you get prints above 50%, like here, here, here. Okay, and then when you get a pullback within an uptrend, like this, like this, like this, what you get is you get just dips below 50% to a relatively shallow level. Obviously I drew those wrong, but when you compare that to last fall, you get a much bigger dip. So there's a big difference between over here, that's a dip within an uptrend because you only got a shallow pullback here. This is more than a dip within an uptrend because you got a much deeper pullback there. So over the last couple of weeks, I was telling my Leavitt Brothers subscribers that, hey, let's treat this like a dip within an uptrend because this is maintaining a pretty good level. So now it's moving above zero, or not above zero, above 50%. So it resets the clock. This continues up. We're going to need a higher prints here, otherwise we're going to get a divergence. And that might be an issue looking out a few weeks. But for now, the weakness here has been recovered, and we start over and we'll see what happens. But for now, things look good. Okay, one more chart. Here's the similar situation with the 200-day moving average. Okay, percentage of S&P stocks above the 200. Let's draw a line at the 50% line. So what I see here is you got a stiff pullback, but this stayed above 50%. You got a stiff pullback here, stayed above 50%. Stiff pullback here, 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 but these drops just simply went back down into the 50% range. This stiff pullback immediately went way down to like 35%. So obviously there's a big difference between this, which is a pullback with an uptrend, and this, which is the beginning of a downtrend. Okay, so again, this is one of those things that, when we got this pullback here, I was telling Leavitt Brothers subscribers, hey, let's treat this like a dip within an uptrend, because so far this indicator is staying above 50%, and I don't think it's going to morph into something worse until this falls down below 50%. I'm not going to treat it like it's going to get worse than it already is. So for Leavitt Brothers subscribers, instead of hitting the panic button when we were over here, they were actually, we were building our list looking for stocks to buy. All right, one more chart. I guess this is the last chart. This is the S&P 500 up top, the Russell down below. S&P, I mean, you could basically say the S&P is traded mostly in a range, other than this area down here at the end of last year, beginning of this year. It's gently trended up, really tradable, because you don't want something that just presses higher and higher and higher. You want the ups and downs, because the ups and downs give trading opportunities. The Russell has spent a majority of its time just in a range, move above, move below, but most of its times below has been in a range. So you're either neutral or leaning up, and I think between these two, what I'm looking for is we have a resistance line there, we have a support line there. If this thing breaks up to the upside there, we're going to need the Russell, if I draw trend lines here, we're going to need the Russell to break out and do the same thing. Okay, if the S&P tries to go but the Russell doesn't follow along, we're going to have a big negative divergence, and that won't be good. So that's what I'm looking for. The Russell doesn't have to lead, but it's got to participate. I want it to lead at the beginning. I want it to really do well, but then if it fades away, that's fine. So for now, I'm content with the way things are. But if the market tries to break out this fall, early winter, we want the Russell to participate. All right. So overall, the market's doing fine. Breadth indicators don't hint at any major trouble. The market has done great absorbing lots of negative headlines. And as long as this remains the case, I do think the market will eventually break out to the upside. All right, thanks for listening, and I will see you next time.